been wild out there. I mean, it's so hard to, you really can't predict or expect when you might get these news announcements, because really it's a headline driven environment where a headline, the president says something, Fed says something, it can just totally throw off what is going on or anything that you may have based decisions on. And it's wild how it's just a wild roller coaster out there. So fundamentals and technicals are struggling a bit, but when we were having such a sell-off like that, it's hard to not expect some sort of jump back that was going to be really big. And I had actually told a few people when I talked to them about this, that we were probably going to see a 10% rebound. And we saw that. It was about 10.5 in the S&P yesterday after the announcement that tariffs would be postponed or pushed off 90 days. So you really can't plan for that. We had no idea that when that was going to be happening, but it did. And there we go. We got an excellent retracement. And then today is just kind of tapering off. So we'll have to see where it goes from there. Although it did hit a fairly good support about a half hour ago, and then we may bounce back from here. So I'm not too concerned yet. But yeah, it's new year, new opportunity, a new season for sure. It feels like a big storm just went through, and now we're going to sift through the rubble and see what we have left, what's working, what's not. There's definitely a big shift in strength and spots of the market. Things that had been very strong and stable had really given up a little bit as well. Not as bad as some of the big things, like tech got just destroyed, semiconductors, the NVIDIAs, and all those kind of got really hit hard. But some of the safer stuff, like shorter term bonds, also didn't hold up as well as they should have, but they did okay. I mean, it wasn't the end of the world, but the news was hitting everything, even the safe stuff, which was really weird. But then yesterday, almost all of it has bounced back to a reasonable place from there. So we're going to talk about presidential cycles, of course, because I think that's just fascinating to watch that month to month to month. I'm probably going to use this chart every month this year. So just to see in context, because it's been so in sync with what is actually happening, even though it's projected years ahead of time. We're going to look at the Fed and interest rate situation. I think that is actually more important than tariffs. And I know it doesn't feel like it that way, but really what ultimately drives the economy is what the Fed does with interest rates. I'll show where they should be and where they are, and a couple of the stats that they're talking about that should influence where they are. We'll certainly look at our regular money flows situation, the stuff that I show you every month, and we'll look at volatility spikes and they tend to happen at bottoms. And I'll show you how that again happens fairly often. We were really pushing that spike, so it's time to look at that again. All right, so big sell-off was expected. So this is looking at the first year of the presidential cycle of the last 7 presidents, right? And that's been through every kind of environment. It was somewhere excellent, somewhere terrible, but it's been all over the map. And this goes way back to before 2000. Every single time you expect a bad time in February into March, and that's exactly what we got. And then you get a grindy sideways, really choppy, tough market to deal with. But we did get this, but it was more in a downtrend. We still had the chop, but it just kept going down and down. Now, once we got into April, look at this. There's a giant spike up somewhere near the end. It looks like it comes out of nowhere, and that's what we had yesterday, a spike that came out of nowhere, seemingly. The seasonality said that's oddly what typically happens around April. And now we're in a spot where we might chop a bit, but then once we get into the second half of April into May, we should have a pretty good run. Historically, we do. Nothing has to happen that way, same way twice, but history does tend to rhyme, as they say. So this has been a good roadmap, and this has been fairly accurate as to where and when things happen in the markets over the first year of a president. So it's interesting to watch. I'm going to keep bringing this up every month because I think it's worth paying attention. Let's look at the Fed funds target rate. This is Tom McClellan's chart that he posts. Probably my absolute favorite chart, and an awesome guy who really understands this stuff well. He has always said, and for years and years and years that I've been following him, that the Fed funds rate should actually just be what the 2-year Treasury bill, the T-bill notes, the yield on those. So right now, I believe the yield is about 0.5 to 0.75% below where the rate is. And the Fed is always late, as I've said. They were late to rise back in 2020 after the COVID crash. They kind of were late on the 07, 08 crash. They were late on the 19, that 2018 issue we had. I mean, they're always late to the party on these things. And they're always like, well, we're looking at data. I mean, honestly, this is the better way to look at where they should be. The expectation now is that they should, at this point, lower at least 3 quarter points, and we'll have to see what they are. But the odds are favoring somewhere in that area right now anyway, so I think they should be in line with where they need to be. Looking at the odds, this is wild. Okay, so as of right now, there's a 20% percent chance that they're going to lower rates a quarter point at the next meeting, which is, I believe, May 7. And then about 80% chance it's going to stay still. Now, if you look at it one day ago, it was a 45 44.5% chance they were going to lower rates a quarter point. Now, the reality is, even though we just had a jump, they probably still should do it. I think they're behind. So that's just more context of what the odds are. It went from a 10% chance a week ago to 45% chance. Now we're down to 20. I'm going to bet if today goes down a little bit, with that, those odds might go up again. As I said in my letter last week, kind of around the panic that we saw, one of the things that we're not seeing trouble is that I would be more concerned about the economy is jobs. This is from the lead lag report. This is actually the trading economics non-farm payrolls. They actually went up quite a bit in March. That was really not expected. The lead lag said the U.S. economy welcomed 228,000 jobs last month, a substantial jump from the downwardly revised 117,000 witnessed in February, and far above what was forecasted at 135,000. So the jobs are actually doing okay. So unemployment is one of those big last factors that we go, okay, once this starts really rising, then we're going to go, okay, here's where recession starts to factor in. And if you go back to my bull market buzzkill from January, I believe it was, I said, I don't really think the struggle, or we're not going to start seeing that until the second half of this year. So it's very possible that we could get at some point a resolution, a rally of some sorts going into there. But then I do think longer term, in the next year to 18 months, in 12 to 18 months, that we should have a very difficult market. Maybe not straight down, but certainly a lot of chop. Volatility is higher than it's been in quite some time, if not ever, that I can recall. Certainly the speed of these drops has been exaggerated. So let's dive into the charts real quick. Even with the long-term trend is down, the moving average is kind of grinding sideways. So we go drastically above, a little bit below, high. All of this chop really hasn't meant a whole lot until this time. So now we are down, but the rally yesterday really did put a lot of money. There was a lot of money coming back into the market yesterday. We'll have to see how that plays out. Now, I know historically, a couple of people have shown data about this, like Rob Hanna has at Quantifiable Edges, showing that after a big day that's up that percentage, 10% or more, it's not uncommon to see the next 2-3 days be choppy sideways or even down. And then it will go on to be pretty good in the next 1 and 3 months historically. Ryan Dietrich at Carson Group also had a similar chart about that. Similar data on that is that after big charts, it's choppy for a bit, but then a couple months out, we're actually could be in a very good place again. But I'm still going to say even if we do that, I'm still thinking we're going to come into a recessionary situation in the second half of this year and probably into next. And some bigger cycles show that. I showed last time the kitchen cycle shows that we are kind of in that situation where it could get ugly in that time frame. It lines up. The midterm, of course, it's been going down. It's been very indecisive. Yesterday was a pretty good push up. Not quite enough to get it greened out, but it was really, really close. So it's very possible we'll see this market start to turn up. Usually when we get a big sell-off and a big rally back, that's when you see money coming back into the market. We did just not enough to get a dot, but it was pretty significant, not to be dismissed. I think that's worth noting. All the sectors in the S&P are negative, big shock there. But interestingly, looking at the RSI 8 specifically, I don't always point this out, but they're above 50. That's actually a positive signal. So we've got technology, consumer discretionary, and that's really mostly Amazon and Tesla, as well as communications. They're all actually somewhat peaking positive. They're all above an 8-day moving average. So we're seeing positivity creep into the side. They're not over here on the directional momentum yet, but that's really where I care about, where I think money is coming in the market. As I said, the buyers are in control at that point. Right now, the sellers still are, but they're weakening. Yesterday really kind of knocked a lot out of it, so we'll see. Going back to the RRG, these were all going straight up into the right before the tariffs. I mean, we were on the verge of getting some big buy signals the day before the tariff announcement. Actually, that day, and they were announced after the close. And we decided to pass on them because it was just too uncertain. I'm glad we did. We're in a slightly defensive state, and that's fine. You always wish it were more when things are going down, but I'm certainly happy that we had been on defense for a good part of that. But yeah, so we had these all pushed very quickly down, but now they're back in the red. So now what I'm looking for is for these little guys to start pushing up and to the right. Technology, here's a hint that it's doing it. What's the other one? XLY is kind of turning there. So yeah, if these start turning up and to the right, then we should see more strength building into the S&P, and that'll be when we should get another hopefully a run up in the market. I don't think we're far from it, but fear and headlines are still running this market. So I've just got to stay aware of context and see how that plays out, because there's definitely a disconnect right now. And then finally, let's look at the VIX. Typically when these big spikes we did, but when was this? This was last summer, we had a spike that was actually higher than the spike that we had this week, which is wild, right? This is, back up to 60, 65 level, I think is where it went. We were only in the low 60s. Still, that's a crazy, crazy spike. And all this is saying that there's a lot of fear in the market. But usually when there's peak fear is around a market bottom, right? peak fear. This is not super huge, but that was around this bottom. And then peak fear again, a lot of grinding. There it was around a bottom. So that may hold up, but this just always makes me think, as Warren Buffett says, be greedy when others are fearful and fearful when others are greedy. And there's definitely fear in the air, and we can see that by the VIX. So